the market keeps doing something investors generally like to see. I know I do. It keeps making new highs. And, I think of that a little bit like climbing to a higher elevation. The view gets better. You can look back and appreciate how far that you've come, but the higher that you climb, the more important your footing becomes. And, you don't just turn around because you've reached a new height. You just pay a little more attention to where you step next. And I think that's a pretty good description of the market right now. Stocks continue to push higher, but underneath those new highs, we're getting some interesting signals from the consumer, from the Federal Reserve, and even the next phase of artificial intelligence. So this week, let's talk about the three signals that I think matter the most. First, the consumer. July retail sales, they were released last Friday, and they fell by 0.6%. So 0.6%. And economists had expected a slight increase, so this was a meaningful miss. And at first glance, that sounds like bad news. Consumer spending is a huge part of the U.S. economy. And when people start pulling back, investors like you, like me, it's natural to wonder if something bigger is going wrong. Now, I'm not there yet. I have not drawn that conclusion. And I think of this more as a little bit more like as a reality check. Consumers appear to be getting a little more selective, looking harder at prices and becoming less willing to simply absorb every increase businesses try to pass along. And I'm sure that we could all probably put ourselves in that position and think about that. I know I can to some degree as far as a consumer. But strangely enough, there's a silver lining in this. What we'll call a grumpier consumer makes it harder for companies to keep raising prices, and that matters because inflation has been the Fed's big headache right now. And if softer spending continues to take some pressure off of prices, it gives the Federal Reserve a little more room to be patient with interest rates rather than forced to keep tightening or keep increasing. So weaker retail sales, it's not automatically good news, but it's not automatically bad news either. And sometimes a little cooling is exactly what the economy needs. Now, the second signal that I'm watching, it has to do with artificial intelligence, but maybe not the part of AI that everybody is talking about. So we've spent, the last few years focused on what I'll call the brains of AI, right? So if you think about that, it's the chips, it's software, the models. And the next chapter may increasingly be about something far less exciting to talk about. And what I think about that, or how I think about it, it's let's call it the power cord. As AI moves toward this what we call AI 2.0, or some people have termed or coined the term agentic AI. And really what that is just systems that are capable of handling more complicated tasks with, possibly more independence. And with that, the energy requirements could become enormous. And that changes the investment conversation because all of these, what we'll call AI brains, they need somewhere to live. They need electricity and cooling systems and power grids and transformers. And we need that capable of handling pretty enormous workloads. So that's why, we continue to think about AI through the old kind of, we'll call it picks and shovels lens. And we've talked about this a lot. If you think about it, way back during the gold rush, you didn't necessarily have to find the gold to make money. Sometimes you just wanted to own the businesses selling the equipment that everybody else needed. And listen, it's easy to kind of talk about this and think it's all a rosy picture. Not all of the companies selling the picks and shovels, right? Or the businesses back then stayed in business and made money. So there's obviously, risks and liquidity and concentration things that we have to pay attention to. But we think AI is increasingly entering that stage. And that just means that the opportunity may extend, I think, well beyond this handful of tech companies that have dominated the headlines as of late. And again, we've talked a lot about that. Think the Magnificent Seven. And I think we're going to start seeing now, okay, well, we need this power cord, and we possibly need a bigger power cord to be able to handle this. I actually had a blog post about this last week that you can see on our website that I think that goes into more detail even than this. So if you're looking for more information on this specifically, I would encourage you to go check that out. Now, I want to talk about the last point here, which is talking about the Fed. Today, actually, we get the meeting minutes from the Fed's last meeting. Now, I know Federal Reserve minutes, they're not exactly beach reading. More like, I can't sleep and I need something to knock me out, right? But technically, the meeting's already happened, but they're still worth watching and they're still worth paying attention to, because the minutes tell us more about how the Fed is thinking. What are they worried about? Was there disagreement? Is there concern about inflation staying too high? All of those details give us a better sense of the framework behind future decision. And that's much more useful than trying to react to every headline that comes across the screen. Now, all of us should be asking, how does this apply to you and to me? For most of our clients, particularly those who are retired or getting close to retirement, our job, as you guys know, our job is not to chase every new market high. It's to make sure the progress that the market has given us actually fits into the plan that we've built for you. So as markets continue to climb, we're paying close attention to portfolio balance. Where strong gains have pushed certain investments above their intended weights, we rebalance. We can rebalance and bring those risks back in line. We continue to focus and try our best to emphasize sectors and industries that show strength and durability. And the reality is we're not going to do this perfectly every time, and there's always risks, but that's why we position size. That's why we manage in the structure that we're managing portfolios. So within AI, we're not simply chasing whatever company happens to be in the headlines, but we're looking across the broader ecosystem. And again, our most recent trade notes that everyone can access on our website, talks about some of the strategic changes that we made, specifically on the energy infrastructure side. And, those are businesses that, do have the potential to benefit as AI investment expands. Again, doesn't go without risks, but we like the opportunity set there. On the fixed income side, think bonds. We continue to value the role that those bonds play and how it pays income, and it's especially key for clients who are drawing from portfolios, because that income gives us something that's very valuable, and that is time, right? It helps to reduce the need to make decisions based on what the stock market happens to do next week or next month. And that's especially important when markets are sitting near record levels. New highs are something to enjoy, but they're also a good time to check our footing. Not because we think something bad has to happen, but simply because the higher we climb, the more important discipline becomes. And for now, the market continues to climb. That's good news. We want to participate in that and have been participating. So as I wrap up, a couple things that I want to leave you with. We're going to enjoy the view from up here. We'll keep checking our footing, and we'll continue watching the signals that actually matter. And until next time, prepared